You're being lied to. The media says the economy's strong, but behind the scenes, recession warning signs are flashing everywhere. And today I'm going to show you the real data that no one's really talking about and exactly what you can do to protect your portfolio. Stick with me, and by the end of this video, you're going to have a game plan to not just survive, but to actually profit in the event that we do have an economic downturn. So let's get into discussing the three major recession warning signs that I'm seeing today. The first indicator is an inverted yield curve. And if you think about what exactly the yield curve should look like, when you have shorter term bonds versus longer term bonds, one would expect that a shorter term bond pays a lower interest rate and a longer term bond pays a higher interest rate. When that isn't happening, that's what is called an inverted yield curve. And that is exactly what we're seeing in the treasury market today. If you look at any shorter term treasuries, whether it's a 3-month or a 6-month or a 1 year, those are paying higher yields right now than the 2-year treasury. So that is certainly an issue. And if you think about every single recession since 1955, they have all been preceded by an inverted yield curve. And it's happening right now. So it's certainly a red flag that we may be headed towards a recession. The Fed says it's nothing to worry about, but history actually says otherwise. In March of 2024, Fed Chair Jay Powell said the economy is healthy per this CNN headline. But let's not forget, this is the same Jay Powell that during COVID, as inflation was creeping up all the way up towards 9.1% year over year, he continued to say that inflation was simply transitory. So you can't believe everything that comes out of the Fed's mouths. And if that's not concerning enough, let's take a look at another indicator hitting record highs: consumer debt and consumer spending. Consumer debt is certainly starting to look very problematic. U.S. credit card debt just hit $1.2 trillion in February 2025. That is an absurd amount of credit card debt. Beyond that, mortgage, auto loan, and credit card delinquencies are rising at the fastest rate since 2008. We are not quite at recessionary levels yet, but we are certainly heading in the wrong direction very quickly. In addition to the $1.2 trillion in credit card debt, there's another large amount of debt that actually doesn't get reported to the credit bureaus, and that's buy now, pay later debt. Essentially, credit card debt, and it's estimated that there's another $700 billion in buy now, pay later debt. In my opinion, one of the best barometers of consumer health can be seen just by looking at Darden restaurants. Now, Darden is the parent company that owns chains such as Olive Garden, Longhorn Steakhouse, Capital Grille. What we've been seeing over the last several years is that their higher end restaurants like Capital Grille haven't been performing as well. However, the lower end restaurants like Olive Garden or maybe even an entry-level steakhouse like Longhorn Steakhouse have been doing well. They've been doing very well. And what we believe has been happening is this concept that's known as the trade down effect, where people begin to kind of rein in their wallets a little bit. They spend less, and rather than eating a $50 steak, they buy a $30 steak. So they're trying to trim some excessive spending that they believe they may have. Recently, we've seen Darden restaurants report weakness now in those lower end brands, Olive Garden and Longhorn Steakhouse. So that becomes concerning. In the past, we've seen higher end consumers trade down to those lower end restaurants. And if that's not enough evidence, let's look at the recent deal between DoorDash and Klarna, a buy now, pay later company. DoorDash and Klarna now have a partnership. So if you want to buy a $10 lunch, you now have the ability to finance that $10 lunch and pay it over the course of 4 payments over the course of 4 months. If you need to take out a loan to buy lunch, we've got serious problems. So that's something to keep an eye on. before I get into the third one, make sure you like this video, make sure you subscribe to our channel, and make sure you ring the bell so that every time we release new content, you're going to be made aware. If you look at the Small Business Optimism Index, towards the end of 2024, it really started to skyrocket as small business owners all across the country were super excited about the potential for great things coming their way, being out there on the horizon. As you kind of moved into the beginning of 2025, you've seen small business optimism begin to pull back just a little bit. That's due to the fact that there's a lot of uncertainty out there today, whether it's tariffs or inflation or taxes. Whenever there's uncertainty, whenever business owners don't have clarity, they end up sitting around in wait and see mode, and they don't move forward on hiring that next employee or buying that piece of equipment. They're pausing right now and waiting until there's more clarity. Small businesses, which is defined as those companies with 49 or fewer employees, produce roughly half of our economic growth, and they employ roughly half of the private workforce. So, if they have issues, you can be sure that they're going to spread into the larger economy as well. So if all three of these indicators are flashing red, why is the market still holding up? And probably more importantly, what should you be doing about it right now? The first thing that's propping up the market is artificial liquidity. You look at all the money that's been printed over the course of the last 4 or 5 years. It's an excessive amount of money that flooded the system and led to artificially inflating the value of not just stocks, but real estate, of assets everywhere. Beyond that, you have stock buybacks at incredibly high levels. Whenever a company decides to buy their stock back, what that does is it raises the price of the outstanding stocks that are still out there. So it's a way to artificially increase the value of a stock without actually making more money, driving more profits. In the past, this has been called financial engineering. The question isn't whether or not the market will correct. The question is, when will it correct, and what should you be doing right now to properly position your portfolio? One of the first things you should be doing is working on building up an additional amount of cash reserves. I always think it makes sense to have at least 6 months of emergency savings. For some situations, maybe it warrants 12 months of emergency savings. But depending on your situation, you may want to have up to 2 years in cash reserves. Now, when we talk about cash reserves, I want you to understand that I don't want that money under the mattress. I want to make sure you're earning 3, 4, maybe even 5% on it. So make sure you shop around and find companies that are going to give you some sort of a return on your money. What's interesting is that the average time it takes for the stock market to peak and then go down to its trough and then regain its prior peak is a little less than 2.5 years. So, if you wanted to ensure that you were fully protected, fully covered through a bear market, maybe you go to 2.5 years or 30 months of cash reserves. A second thing you can do is you can become more defensive in your portfolio. The most defensive sectors tend to be consumer staples, healthcare, and utilities. Those normally are not thought of as the highest growth sectors that are out there, but when things get tough, you can certainly look to preserve much of your value by investing in one of those 3 sectors. Beyond that, if you look at from a stock factor standpoint, dividend paying stocks tend to hold up much better than non-dividend paying stocks anytime there's a market downturn. The third thing is to be patient and wait for buying opportunities. This is something that the wealthy and the ultra rich do so well, but because of behavioral finance issues, the average investor really doesn't tend to capitalize on these opportunities. Warren Buffett has once said, "Be fearful when others are greedy and be greedy when others are fearful." And if you think about market corrections, the S&P 500 tends to rebound by an average of 47% within the first 12 months after every single market bottom in history, according to JP Morgan. Let me give you an example of how to be patient and wait for specific buying opportunities. And I'm going to use a specific stock here. I'm going to use NVIDIA, which has essentially been the poster child of the AI, artificial intelligence rally over the course of the last several years. This is a stock that has hit $150+ a share in recent memory. When that stock was at $150 a share, do you know how many people were kicking themselves that they didn't buy it at 100? Well, guess what? That stock ended up selling off and dropping all the way down to around $105. Do you think they ended up pulling the trigger and buying it when it got close to 105? More than likely not. So what I suggest you do is you identify those high conviction companies that you love. Maybe you own them right now and you wish you owned more. Maybe you don't own them, but you wish you did. You'll have your opportunity. You need to come up with a game plan in a bull market when the stocks are doing well. And you need to write down the price point whereby you would consider buying that stock if it sold off, if it was on sale. So for NVIDIA, as an example, maybe that was 120 or 110 or 100, whatever it is, write it down so that when you are shaking in your boots and your knees are a little weak, you don't miss that opportunity. You remember and you committed to yourself that you were going to pull the trigger when it hit that specific level. The bottom line is smart investors don't panic. They position themselves to take advantage of market downturns. They want to be opportunistic. They want to buy assets that are on sale. So comment below. What's your biggest concern right now about the stock market? What's your biggest concern about the economy? I'd love to hear that. I'd love to give you my feedback. If you found this breakdown helpful, make sure you hit that subscribe button and like this video. Every single week, I'm putting these videos out, sharing market insights, sharing economic insights, retirement planning strategies, financial planning strategies, stuff that you may not hear in the mainstream media so that you can protect your wealth, you can grow your wealth, and you can live the life that you want. In the meantime, hit the subscribe button, like this video, ring that bell, and follow me on X at Mark Tepper SWP.